Hey everyone, welcome. We're excited to be here with all of you and talk about rental property investing. Before we dive in, I want to quickly introduce our speakers for today. I'm Ryan Frazier. I'm one of the co founders and the CEO of Arrived. And investing in rental homes has been a passion of mine for over a decade. And I'm thankful to be chatting with everyone here today. Cameron is our VP of investments. Cameron is going to share more about how Arrived works and some of the benefits of Arrived. And then Jake, our head of operations, is going to walk through some of the things to think about when investing in real estate and how to get started for anyone who's interested. If you have any questions, please submit them through chat. Our team is going to be responding live, but we'll also bring up some of those questions for Q&A at the end of the presentation as well. To start, we've got a great agenda for today as well. I'm going to share some of the benefits to investing in real estate and the different ways to invest in real estate. I'll also share a quick introduction to Arrived. And then Cameron is going to take over and get into some of the specifics for how the Arrive model works and the benefits that Arrive could offer for investors. And Jake will finish up really walking through some more things to think about with investing in real estate and then how to get started for anyone who's interested. After that, we will take live questions from the audience and then we'll break from there. So let's start with some of the benefits to investing in real estate in general. One of the reasons that investors have long seen real estate as an important part of their overall investment portfolio is really just due to the fact that you can earn money in multiple ways. The first, from property value growth, where you can see appreciation in the value of your real estate over time. And the second is really from rental income, people paying rent, providing cash flow for operating a property as a rental. And the last is one thing worth mentioning is just that real estate can have favorable tax treatment as well, and the opportunity to defer tax on things like rental income with using something called depreciation as an offset. Next, it's worth mentioning that real estate has really seen strong historical returns. The two charts that I'll walk through today are from the Federal Reserve Bank. The first one is looking at the price of rent over time and how rent prices have changed. The second is looking at median home prices in the US over time. And really the consistency in rental rates growing and median home prices growing over time and the ability to earn money really from both of those sources has made real estate such a consistent source of generating wealth over time. One of the next reasons that investors often consider real estate is just related to overall portfolio diversification. And this really ties back to modern portfolio, but the simple concept is that for risk averse investors, a well diversified portfolio can maximize returns based on any given level of risk. And real estate as an asset class has historically had a lower correlation to the stock market, and as a result is often recommended as a complement to some of these other asset classes. And then finally, real estate provides access to low cost leverage. Leverage or debt can increase your purchasing power beyond the cash that you have available today. And as a result, that can magnify your potential for returns, either up or down, depending on how your investment performs. And real estate has long had one of the lowest cost of leverages through the use of mortgages or long-term mortgages, and really just because it's such a tangible asset that holds a lot of resale value. So with that, how do you invest in real estate today? First, there's several types of real estate to think about. Starting with commercial or industrial properties, things like office buildings or warehouses. Then there is residential properties like single family homes or multifamily buildings. There's vacant land. There's now vacation rental properties, like properties that are operated on Airbnb. And there's also real estate debt investments, things like investing in the financing that backs professional real estate development projects. And when you think about how to invest in real estate, there's a couple of different ways to invest. You can invest in property directly, where you go through the full process of searching the market, submitting offers, taking out a mortgage, potentially if you're buying a home, and then managing that property over time. There's also the ability to invest in REITs or real estate investment trusts. The most common types of REITs that people think of when they're thinking about REITs are really publicly traded REITs. And you can buy shares through your brokerage of choice. They can offer great tax benefits without needing to manage the properties yourself. But since they're often publicly traded, they're also more correlated to stock market performance. And their prices can be more volatile than the actual underlying real estate values. And that can also compress dividends associated with these REITs. Then there's a new generation of real estate investing platforms. There's some great companies here that early on had focused on commercial properties, like apartments and office buildings. And then Arrived also fits here as a real estate investment platform. And our focus has really specifically been on residential single family homes and making it easy for anyone to invest in all aspects of the single family home market. I've personally been really passionate about residential homes, which is one of the things that led to creating Arrived to begin with, so that anyone could invest in this segment of the market and into single family homes. Homes can be a great way to get started in your real estate investing journey. They are quite easy for new investors to real estate to understand, because the value of the house is driven by its location, its curb appeal, the rental potential, all things that people are really able to consider and evaluate at face value on any given investment. From a market perspective, new home construction has just not been able to keep up with demand for houses over the last 10 to 15 years. And this is why we've continued to see home prices grow at an accelerated rate. We're also seeing a generational shift where more people are renting for longer periods of their life just to have that greater flexibility. And this means more people looking for renting larger places to live as perhaps their family grows, and renting homes. And with Arrived, we really offer multiple ways to invest in single family homes. We have individual properties that allow investors to pick and choose which properties they want to invest in and have really that full control of exactly how they want to build their rental home portfolio. With the single family residential fund, we allow investors to invest in a diversified portfolio of properties that our professional investments team manages on their behalf. So it's more of a passive way to, or even more passive way to invest in the rental home market. And then with the private credit fund, we're giving investors the opportunity to invest in a fund that finances professional real estate projects. These are short-term loans of 6 to 36 months that are really backing full home renovations or rehabs performed by real estate professionals, and allow investors to access really compelling yields in the residential market. Despite these benefits of investing in the single family home market, though, in the past the process has really just been complex, uncertain, time consuming, expensive, and pretty much all offline. And our vision for Arrived has been to completely change that so that we can make single family home investing really accessible to anyone at any time. And that's what we're focused on. Arrived is a platform for investing in shares of these individual investments of single family homes, vacation rental properties, and real estate backed debt investments. And through our website and our mobile app, investors can browse available investments. They can buy shares in any of the homes or investments that they like, and can invest online by connecting their bank account. From there, after you invest, you earn passive income from rent, appreciation as property values grow. And this we really view as an exciting innovation in rental property investing. And we've been really humbled and honestly blown away a bit by the level of interest in investing on Arrived. And now over the years, we've become the largest platform for investing in shares of residential properties. We've built an incredible track record thanks to our investing community. And we have an incredible group of backers in our company, and we're excited to continue to grow with the Arrived community here. And with that, I will hand it over to Cameron to share a bit more details on how Arrived works. Thank you.
Thanks, Ryan. Now we're going to talk a little bit about how Arrived works. So, in the acquisition process, as we're looking at all of the real estate that's out there, we analyze markets and neighborhoods, and we want to have good conviction on the areas that we're buying in. So, first, we look at those markets and those neighborhoods, and we look for a couple of things. The first is positive net migration. So, it's population growth. How many people are coming in and how many people are leaving that market? We want to see a strong positive trend there. Then we also look at the infrastructure of the city. So, is there enough highways and freeways to support the movement of goods and services and people and for neighborhoods to keep growing? And then finally, we look at a diversified economy. We want to make sure that there's jobs being created, that there's strong industries, and that it can be fairly well insulated against any sort of recessionary forces. Right? People need to be employed, people need to be generating income, and then they can pay the rents as well as eventually pay higher prices for the homes when it is time to sell. Once we have that more macro conviction, then we go bottoms up and look at the right homes to buy. So, does it have the right profile from the perspective of generating enough rent relative to how much it costs? Is it in the right neighborhoods that are in the path of progress? Are they in high crime areas? We try to look for areas that um, have minimal risks with respect to that. Although always not always, although it's not always unavoidable. When you are investing in the path of progress, sometimes they are in neighborhoods that are on track to become better, but are can be challenging in the moment. Then we improve the homes. So most of the homes that we have been buying are of a newer vintage. We buy plenty of new construction, but even at new construction, there are things to be done, appliances to be ordered, window treatments, and then importantly, putting in a fence. A lot of people, when they're looking at single family homes, they want a fence, whether they have children or whether they have pets. A fence offers really strong utility. So, to the extent that it's economically feasible, such that it's not a tiny home on a huge lot, that may be challenging to add a fence. But most newer construction, they're on reasonably sized lots where it is feasible to put that fence in. Next, then we operate it for rental income. So with long-term rentals, they are operated as kind of a landlord-tenant model, and then we also have vacation rentals. So those same homes that we think are great assets, we create great designs, amenitize them appropriately, with really the idea of generating a lot of income. So we can operate it for rental income, or we can operate it for guest income in the case of vacation rentals. And finally, we offer it to investors. So we go through a process with the SEC where we are validating the information that is in the offering, that we are making the investment terms known, and overall investors would have a transparent experience. So, next, let's talk about some of the benefits of investing with Arrived. The first is passive income. You can start earning rental income and receive monthly payments. I don't know how real estate really got the reputation of being a passive activity because it's anything but passive. It's extremely active when you consider all of the things you have to do. But at Arrived, we make it a very passive experience where you invest in the properties that you want to, and then from there, you collect your income on a monthly basis. Next is capital appreciation. So, one of the great things about investing in real estate is that over time, real estate markets will tend to increase the price of land, increase the price of the structure. And if you hold properties for a year or longer, you get long term capital gains. We'll cover that a little bit more in the tax treatment section, but real estate has historically experienced that capital appreciation. One quick note on that: if you're investing in our private credit fund, then you would not have the expectation of capital appreciation. The private credit fund is a collection of assets where the underlying assets are real estate loans that are short term in nature for real estate projects. And we intend to hold them to maturity. So you would get the interest income getting paid out. But when you hold it to maturity, you get all of your principal back. So there's no real expectation of that appreciation. But if you're on the equity side where you're investing in the long term rentals or the vacation rentals, then there is that expectation of capital appreciation as the price of assets increase. Next is no liability debt. So you can access debt with no liability for the investors. So this is a really great program that Arrived has structured for taking out mortgages on properties. So one, as an investor, you don't have to independently qualify for credit to get the benefit of using it. So there's no credit checks, there's no presumption that you have to have qualifying credit to be able to invest in properties that carry a mortgage. And the second is that our debt programs are non-recourse. And what that means is that there's no liability to the investor, and they can never be responsible for the repayment of any sort of mortgage debts that the property carries. And finally, no operational responsibility. So there is no responsibility for finding the properties, acquiring them, managing them, or anything to do with the SEC. We take care of all of that for you. So we do truly make it a passive experience without that operational responsibility. Next, tax advantages. So there's a couple great tax advantages, some involving investing in real estate, and then others involving how Arrived has structured the investment vehicle. So first, on the real estate side, you get the benefit of depreciation. And what that does is that it defers the taxes that you generate on operating income for the property. So depreciation is a non-cash expense that really accounts for the wear and tear that any long-lived asset is going to have over its lifetime. So you can imagine that with a building or a house or any sort of structure, over time, Mother Nature does her thing and kind of uh, makes the building less valuable than it was in a sense because it does wear and tear. So the IRS allows you to take a deduction against revenue to account for that. Now it's a non-cash expense, meaning that there's not money that's coming out from any bank account to pay for depreciation. It's that you get to reduce your income. So in effect, what it does is it allows you to get the operational cash flow without having the liability for the taxes in that moment. The second tax benefit associated with investing in real estate is what I had mentioned earlier with long term capital gains. So, if you hold an asset for a year or longer, then it is subject to long term capital gains treatment, which in today's environment is 15 to 20%, depending on your income. And you compare that with, say, the ordinary income rate on wages. Typically, that highest marginal rate is above 30%. So, there's a lot of tax savings in being able to sell properties for gain, and then owe less taxes on that gain. Next is low minimum investment. So you can start investing with our low $100 minimum, whether it's individual offerings or the SFR fund or the private credit fund. And let me give you an example of just how this might work. Let's say that there's an individual property that you want to invest in, and you could buy shares of that property for as low as $100 per investment. So that's 10 shares at $10 initial starting price. Now that's great, if you're buying that one property, and let me show you how it works with the SFR fund. So it's a collection of long-term rental properties, single-family residential, as the name implies, that are composed of in the fund. And let's say that there's 20 properties in the fund. You can still invest that same $100 minimum and get diversification across all 20 properties, as well as a stake in the fund itself, which is made up of those 20 properties. And if you were to try to do that individually, then you would have 20 separate investments of $100, and you would need $2,000 if you wanted to do it individually. So our SFR fund is really a great amplification of this already low minimum investment of $100. And the same goes with the private credit fund. If you think about the traditional way of investing in real estate, the minimum amount you would need to invest in any sort of rental home is probably somewhere around the neighborhood of $50,000, even if you were taking out a mortgage. You got to have the down payment. You have to have enough money for renovations. You have to have enough money for closing costs and all the startup costs and the property taxes and all of the costs associated with it. So it's no small amount to even get started with just one rental property, much less investing in a basket of properties for as low as $100. Next, diversification. So you can distribute your portfolio across multiple properties all across the country. And with our individual offerings, you can craft your own portfolio for as low as $100 per individual investment. Or as we were talking about in the SFR fund, you get that instant diversification. So really, Arrived has crafted a lot of great ways for you to make individual bets as well as get easy diversification for any amount of capital that you see fit. And then finally, we're talking about flexibility here. So Arrived has really taken a large asset like a home, like an investment home, and we've chunked it up into a lot of small investable bites all across the country. So you have flexibility to uh, spread your money and get into a lot of different properties and really invest outside of your own backyard. I come from a real estate family myself, and we did really well with where we were, but we were always confined to the location that we were in. It was hard to have that portable game plan and spread it out across different states and different markets. So we were always limited to where we could invest. So with Arrived, it's a really great feature to be able to invest across all the rest of the country, right? You can go outside of your own backyard and make great investments all across the country. So with that, I'm going to turn it over to Jake so he can explain a little bit about returns and the financials.
Thank you, Cam. Cameron and Ryan talked a lot about the reasons for investing in real estate. And now we're going to take a dive into a bit of the potential returns of arrived investments. This chart is meant to illustrate the potential range of returns for each investment strategy. In this chart, the dot represents the average return for that specific investment strategy, and the lines represent the distribution of typical outcomes. You can see that investments with higher average returns also come with a wider range of potential outcomes. This illustrates the different range of volatility or risk in the performance of each asset class. Investments with higher return potential also come with a wider range of potential outcomes. To try to mitigate that range of outcomes, investors can diversify into several different properties. The more offerings within an investment strategy that you invest in, the more likely your overall returns will be closer to that average. To do that, you could buy several different properties within an investment strategy or invest in our funds products, which are already instantly diversified across dozens of individual properties. This chart is very similar to the last one, but instead of looking at investment strategies, we're looking at the impact of adding leverage. When you add a mortgage debt to a real estate investment, you amplify the results. It adds an additional layer of risk, but it also adds potential for higher returns to the base risk return profile of that investment. As you add leverage, the average return increases, but the range of potential outcomes also expands. Leverage will make a good investment really good and a bad investment really bad. With interest rates still quite high, we aren't adding leverage via mortgages to the properties right now. However, we are aiming to in the future. Properties will have a strategic refinance candidate tag on their property page. And that indicates that even though a property is launching to investors without debt, we're hoping to add a loan to it in the future when interest rates come down. These future refinances would give us an opportunity to see the operating performance of each property play out, allowing us to make better decisions on which properties to add leverage to and at what interest rate it makes sense to do so. And that brings us to this matrix that shows the intended range of returns for each investment strategy with and without debt. Like I was just saying, all of our new properties are launching without leverage, but we hope to add leverage to those properties when it makes sense to do so. Ultimately, the returns of each individual investment will depend on the performance of that specific property's rental operations and appreciation in the local market. And that means that some properties will certainly outperform these ranges and other properties may underperform them. These numbers represent a well-diversified portfolio within each investment strategy and leverage combination. The more investors diversify into a number of properties, the more likely a portfolio's overall returns will end up in these ranges over the target investment period. Like we were discussing earlier, you can diversify on arrive by buying shares of different individual properties or by investing into our funds products that have instant diversification. And that brings us to the fun part, which is how to get started. The account creation process takes about 4 minutes. And from there, you'll be able to start browsing properties that are currently being funded by investors. You can take a look at the different investment strategies and different properties to pick which ones interest you. And then you simply select the number of shares you want to buy. From there, you start earning the income and appreciation from your investment. We can pretty much guarantee it'll be the easiest and most fun real estate transaction you've ever had. And with that, we'll turn it over for some Q&A.